Hey everybody, Randy Patrick here. Time for Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Today is Monday, April the 29th. We got a lot on the go. Today's topics are U.S. home ownership rate, median rent prices, U.S. home sales prices, Q1 home sales report, some Airbnb competition, and of course some of my favorite topics, mortgage fraud. Yes, mortgage fraud. So, by the way, please help our channel grow. If you're not already a subscriber, I'd love it if you just click that little button in the bottom right corner and subscribe to my channel. Thank you very much. All right, let's talk about what's going on today. Big news was the U.S. home ownership rate declines in the first quarter of 2019. So the home ownership rate was down 0.6 of a percentage point from the fourth quarter of 2018. Okay, 0.6 of a percentage point, it's not huge, I get it, but please understand it's a starting point of something. It shows a trend. And the rate has had 8 consecutive quarters of year-over-year increases. The first quarter rate is 64.2% of home ownership, roughly unchanged from about a year ago. And the segment that saw, I guess, the biggest drop that sort of pulled the rate down was the under 35 segment. It dropped 1.1%. And the analysts are saying, well, this is anemic growth rate for that under 35 segment. There's obviously some reasons for that. Some of the stated reasons are securing a down payment, and we've got finding a home within someone's budget, or also qualifying for a loan. So the 4 main reasons why the rate declined overall: stock market volatility. So apparently when we have stock market volatility, it hurts consumer confidence, which means people don't actually go out and buy products, including homes. So there you go. People are choosing to keep on renting, and the reason being sort of goes back to what I just said. Tough to save up enough money for a down payment. Not only that, to purchase a home and the associated costs, because once you pay for your home, you still have other costs that you're going to incur to get started, furnishings, the whole bit. It could be, lawn work, yard work, lawnmowers, appliances, things you have to buy to get your new home up and running. So obviously it's a big cash outlay for people, and that's a big concern. Younger people are just not buying homes. Obviously the millennial generation, they're the under 35. The 1.1% loss this quarter kind of reversed the previous gains that it had. And also Generation Xers, referred to as 35 to 44 age demographic, their rate dropped almost by a full percentage point as well. And sort of diving deeper into this, some of the analysts say that the millennial generation less likely to take financial risks, and also they feel that renters need more convincing to become homeowners. Okay, well, how do you convince a renter to become a homeowner? You show them that homeownership is actually better for them financially and is more stable and secure. But today we don't know if that's actually available or not. So it's one of those weird things. So I guess that's how I would try to convince somebody to purchase a home, do the old rental versus purchase analysis. But maybe in today's day and age, I'm pretty sure that it's going to be in favor in most locations for renting. So there you go. Which leads us to the fact that the median rent has reached an all-time high. And this is according to the U.S. Census Bureau. We do hear different rental rates, bantered about from different reporting agencies, etc. But the U.S. Census Bureau median asking rent reached an all-time high, rising to a record of $1,006 in Q1 2019. So this again is a broad-based average rent, whether it's a 3-bedroom, studio, whatever. It's all the rents are the averages I'm assuming here. Now, interesting enough, rental vacancies were 7% in Q1 2019, which apparently is quite low, and that contributes to the increase in rental rates. Why? Because of more competition. So clearly more competition for rental properties, landlords, multifamily housing complexes, etc., apartments, whatever they are, single family rentals, it doesn't matter. When there's competition, you can push your rental rates up, and we know that people do this all the time. Great to renew your lease. You've got some fixed increases there. You're jumping into a new rental location. The landlord can rent whatever he or she wants to rent it at. So, which also gets us back to millennial issues that we spoke about earlier. Can't or won't, or just not ready to become homeowners. So you're kind of stuck in this situation here. So again, more competition means increase in rates in the rental community. So I look at it now. Effectively, we have 2 bubbles that we're working on here. We have simultaneous bubbles. We have a price housing affordability bubble that's hurting people, and now we have a rental rate bubble that's going on at the same time. So both of these can't be good for housing, and we can see how they're causing some problems. All right, so U.S. home sales price experiences the first annual decrease in 7 years. And guess what? We have a visitor today. It's Bubble Kitty. You can see how she just makes herself at home when I'm doing anything on a table, on a desk, in my office, whatever. So anyway, ignore her because I will. All right. So anyway, U.S. home sales prices experience. Well, now I got to get you off this because I can't see what I'm actually reading. All right, go. So March sales prices were virtually stagnant, inch backward about a tenth of a point to a median of $295,000. So this is the first annual decrease in 7 years. Now this is according to Redfin, and obviously Redfin's going to work on whatever data sets they're using. Could be their own sales, could be how they rationalize or nationalize it, etc. But it's really the first year-over-year price decline since 2012, of February 2012. Now that's 7 years. It's quite some time. Again, a tenth of a point is not material, but as I always say, it's the start, because you have increases, you have lower and lower increases, you have plateau, and then you have a slight decrease, then starts to pick up steam. So basically what the issue is that we finally, at least according to Redfin, we've kind of hit that inflection point where, hey, we actually had a slight, ever so slight decrease in sales. So sales values, essentially. West Coast sales dropped the most. So Los Angeles, Orange County, Seattle dropping by over double digits, whereas the East Coast sales actually increased. So we sort of see this West Coast high price area normalizing down, East Coast getting some benefit of having maybe some more affordability, but everything's kind of balancing out right now. Home sales fell in 37 of 85 of the largest markets. So we're starting to see almost getting close to that 50% area where things are starting to drop. So just keep that in mind. But again, not a huge decrease, but a decrease, and it's actually gone below the line, which I find is quite interesting. Adam Data Solutions released their Q1 U.S. home sales report, and it sort of goes back to the revenue or the profit homeowners actually, I guess you could say, earn when they sell. So homeowners that sold in Q1 2019 realized a $57,500 gain since the purchase, and that actually was down from a $60,000 gain just at Q4 2018. So we had a slight decrease there. The average return on the purchase price for homes sold in Q1 2019 was 31.5%. So what you sold it for, what you made, there's the percentage point right there. $57,500 plus a 31.5% return. Now the average homes that were sold in Q1 were 8.05 years. So what that basically means is the fact that you own that home for just over 8 years, and that's home ownership or home tenure, they call that. So it's actually down slightly from the record of 8.17 years, which was Q4 2018. What we're really seeing now is the fact that people have hung onto their homes longer over the past few years, I guess, really to see the market increase, stabilize, and actually try to get the most equity they can out of it, which seems to make sense. But now we are actually seeing profits and sales prices kind of softening as time goes on. Median home prices in 73 of the 123 metros analyzed in the report, 59% were above, I guess the sales prices were above pre-recession peaks, led by it's Greeley, Colorado, Denver, Colorado, Fort Collins, Colorado, Austin, Texas, and Dallas, Texas. Now, as a side note, I've had a few people that have actually inquired and sent me emails saying, what do I think of the Dallas market? What do I think of the Colorado Springs market, etc.? So you can see that these two states here pretty much had, they've earned a lot since the pre-recession peak. So, and if I go back to my recollection, these two markets didn't have a huge price spike and decline back in the last housing crisis. So markets that didn't have that big delta tended to have a better, stronger growth afterwards, and thus you're seeing it right now. Now, median home prices in 49 of the 123 metros, which is 40%, were still below their pre-recession peaks. They're still below their peak. That's York, Hanover, Pennsylvania, Trenton, New Jersey, Atlantic City, New Jersey, Bridgeport, Stamford, Connecticut, and New Haven, Connecticut. So kind of that little eastern seaboard area right up there having some issues. They have not got above the pre-recession peak yet. Highest average sales return. So this is basically the percentage point that the people that made the most money on their homes were San Jose, 84%, San Francisco, 71%, Seattle, 63%, Modesto, California, 59%, and Salt Lake City, 56%. So the top 5 here are basically, I would say, West Coast. I'd call that West Coast homes. I mean, Salt Lake City is probably a little mountain time here, but I'm looking at it from where I'm sitting. It's the West as far as I'm concerned. But again, pretty significant sales returns for homes that are sold in Q1 2019. Now, just for interest's sake, sales to institutional investors, 1.8% in Q1 2019, down from 3.7% the previous quarter, so less institutional investors were buying homes. Distressed sales accounted for 14.2% of all sales. It's up from the previous quarter, but down year over year when it was 15.2%. And distressed sales from Adam Data Solutions includes short sales, REOs, and also online auctions. And I have had people who've commented and asked questions about, when we calculate distressed sales. So when I talk about, say, information from National Association of Realtors, NAR, when they talk about any of their statistics, just so you guys know, that basically is because it's NAR, National Association of Realtors, they're only pulling from their statistics, which is MLS based, all right? So anything that's off market doesn't count. Whereas something like Adam Data Solutions, it's pulling from just basic sales information that it can get anytime and different sources, pulling them all together. So the distressed sales accounted for 14.2% of all sales. Clearly she's not going to let me get through this without bugging me anymore. Come on, off you go. Off you go, little one. There you go. All right. Okay, there you go. So again, that's the data capture. So NAR is pretty much MLS. Adam Data Solutions kind of gives you a broad base. So things like Hubzu, Auction.com, online auctions, whatever, those are factored into the Adam Data Solutions numbers, not from the NAR numbers. All right. Of interest note, FHA buyers share dropped 7%. 8th consecutive drop by quarter for FHA affordability. Simple as that. Okay, other news here. Marriott International, the world's biggest hotel operator with 1.3 million guest rooms globally, is now ready to take on Airbnb. And how I look at this is very interesting because it plans to unveil first phase of their home rental business platform next month. So obviously, as you know, Airbnb, a big business. Hotels dislike Airbnb. Hotels have been lobbying aggressively against Airbnb at the state and local level, wanting to do away with Airbnb for competition, or at least limit the accessibility to Airbnb platforms. And their argument's always been, well, if you go to stay at a hotel and say it's Hilton or Marriott, whatever your bill says, there's going to be a state tax for room tax or whatever fee is going to be on there every night you stay that's levied by the state or the local government. Well, people who are doing Airbnb are effectively avoiding any sort of taxation at that level. So therefore, the hotels are lobbying, saying it's unfair competition. If you're renting out your room on a short-term stay, you might as well be a hotel motel. You need to pay the same taxation rates that we do. So, and again, some cities have kind of, I guess you say, constrained Airbnb availability and rental opportunities. There's always some debate going back and forth. I just find this move kind of interesting by Marriott. It's look almost like an industry disruptor. So you're at the point where, okay, Airbnb is obviously doing well, and in my opinion, if somebody like Marriott, who is the largest hotel guest room operator in the world, as it was again 1.3 million guest rooms, they're going to take a shot at this and now get into the home rental business. So it's kind of like, okay, you want to play over here, we're going to play over here as well too, which is kind of interesting. So we'll see how this all pans out, but we'll have to keep our eye on it. But what it goes to show you is yet another group who wants to get into the housing business. And the Marriott's now, Marriott's, as they're hotel based, and there's resorts and things like that, and you can own a condo or own a townhouse in a resort which you occupy for so many weeks of the year, and you let them rent it out for you or hotel it out and pay for some of the mortgage, etc. I mean, people do that as well too, but I don't know. It's too early to figure out where this is going to go. But yet another large group who has the cash could come in and start saying, hey, we're going to start buying up properties and converting them to short-term rentals for all we know. We don't quite know the plan yet, but I think it's very interesting. So, you've got Zillow who wants to get in the ball game with home buying, selling. You've got Keller Williams announcing they're going to do so. You've got all these third-party application platforms that are jumping to say, I can buy your home and fix it and sell it, or I'll buy your home and lease it back to you. You've got all these things going on in this business, and this is just one more person or one more group that has capital that's trying to get into and disrupt the home selling business, home market business, etc. Very, very interesting as far as I'm concerned. All right, mortgage fraud. All right, here we go. So CoreLogic every quarter releases their Mortgage Fraud Insights report. So I downloaded the Q1 2019 Mortgage Fraud Insight. And of course, mortgage fraud is up. There are no surprises there. Typically, when we have markets that have appreciated, or we've gone through a phase of appreciation, or when we've gone through peak values or high values, mortgage fraud tends to take place. Now, mortgage fraud, there's various, we'll call it, I won't call it offenses, but I guess levels of mortgage fraud. The number one issue that they're experiencing right now is falsification of income. So mortgage fraud, you could have income falsification, you could have occupancy fraud, which is, well, I'm going to buy this as my primary home, but I'm going to rent it out as an investor, you see, so that's fraud. There could be name fraud or identity fraud. There could also be, fraud with respect to sourcing money, etc. And also the fact that here we're talking falsification on mortgage applications. So basically what that means is people overinflate their value of their income in order to qualify for higher mortgages or get higher loan-to-value loans, which obviously helps them keep more money in their pocket and have more of the lender pay for that property, pay for that property purchase. Just so you know, the fraud is up 6% year over year. And again, the top 15 locations, again, not a surprise here. I've got a chart with the top 15 locations. Miami, Fort Lauderdale leads the way. Deltona, Daytona Beach, Ormond Beach, Florida, number 2. New York, Newark, New Jersey. So these are kind of MSA areas, metropolitan areas. Los Angeles, Long Beach, Anaheim next. Tampa, St. Petersburg, Clearwater, urban Honolulu. Okay, urban Honolulu. Next, Lakeland, Winter Haven, Florida. Cape Coral, Fort Myers, Florida. Northport, Sarasota, Bradenton, Florida. Jacksonville, Florida. Orlando, Kissimmee, Florida. San Diego, Carlsbad, California. New Orleans, Louisiana. Oxnard, Thousand Oaks, Ventura, California, and Worcester, Massachusetts / Connecticut. So it's interesting to note that more than half, so 8 of the 15, are in Florida. And again, this is not a city like Tampa, Clearwater, St. Pete. It's kind of like our metropolitan service area. So when you start looking at MSAs, that's pretty much half the state, most of the population they've covered with the top 15. It's kind of a joke. Florida is like in the top 7 of 10. Looks like for fraud applications, etc. So again, this is not surprising. This typically happens prior to a housing bust. When bubbles are going, people want to get into the opportunity, buy and sell property, and they do what it takes to get their piece of the action. Fear of missing out, FOMO, and they want to get in, they want to buy, they want to sell, own, whatever they want to do. But it's not surprising that certain locations see a fraud uptick when values have peaked and investing is going on and stuff's happening in the marketplace. So this, when we look back in time and took a look at some of the issues with the previous housing crisis, mortgage fraud increased dramatically over the buildup of the last housing bubble as well too. Same thing. A lot of it is, as I said, inflation of income, usage fraud. Yeah, it's my primary. I mean, I have many examples of people who were saying, it's my primary, you nod your head. All you had to do to say to the mortgage application or the mortgage loan officer was, I intend on occupying the property as my primary residence. And then you were slotted for a primary loan with a higher loan to value, and whether you did or not afterwards, there's no balances or checks to make sure you occupied as a primary, and nobody cared. Therefore, that caused a lot of issues. So you can see that stuff like this is rampant in appreciating / bubble markets. It's happening right now. It also happens you can see regionally, and it happens various cities that tend to be more exposed to it than others for various reasons we won't get into today. But there you go. So that's the scoop. Again, I have to laugh when I look at 7 of the top 10, 8 of the top 15 are Florida-based where I live. So anyway, that's it for today. Thank you for the views, the likes, the shares, and comments. Hey, please share on your Twitter or your Facebook. That would help me quite a bit too. And as I mentioned earlier in the video, if you're not a subscriber, please do so. Help my channel grow. I'd really appreciate it. So click that subscribe button. If you're in the greater Tampa Bay area, I have a distressed property event going on this Saturday, May the 4th, 9 a.m. to 4 p.m. I'll put the registration link in one of the comments. It's a great event. It's a full day of training, very intense. A lot of the stuff I talk about here in the videos, I get into deeper detail with more statistics and graphs and stuff we can look and talk about. And also I talk about how you can never pay retail and buy stuff at a discount if you know where to look, how to find them, and what to do with them when you get your hands on them. That's a scoop. So again, feel free to get a hold of me for all your real estate needs. I know people have, and I appreciate that. Whether it's retail, investment, becoming a real estate agent, whatever you want, I'm here to talk. I always respond to people the best as I can and look to help people in the future with all your real estate endeavors. So again, thank you very much for watching, and I look forward to speaking with you before the week is out. Thanks.